So I want to start with, just recently, the stress test for the banks. So these stress tests were put in place after the credit crisis to make sure banks had enough capital on the balance sheets to withstand these three things, which have to happen at the same time. A 10% unemployment rate, it's going to rise above 10%, general 50% drop in stocks, and a 30% plunge in home prices. Again, that has to happen at the same time. So they have to have that kind of capital in that type of environment, which hasn't happened. It didn't happen during the credit crisis. I don't know if we saw the 30% plunge in home price. I think it was a little less than that, but unemployment didn't get to 10%. We did see that 50% drop in stock prices. But that hasn't happened since the Depression. But yet banks are forced to keep this capital on their books. And you're looking today where stocks, okay, we're down more than 15%. Unemployment rate is very, very strong at full employment. Below 4%. Home prices are holding steady. It's increasing dramatically post-COVID when it's not seeing, huge declines. People are coming down in terms of, the sellers and selling their homes. I'll talk about that in a minute. But when you have these types of requirements, it's no surprise all 33 banks passed with flying colors. And again, we are pretty much in a recession right now. You could argue, you could debate. It's not the definition of recession, but we're basically in a recession right now. Or maybe we'll officially be in a recession early next year. But to see a decline in stocks and a lot of positives with balance sheets are flush with cash, the banks are perfectly fine. People have more capital in savings, right, that they could put into the market right now because they're nervous. But there are positives considering, the inflationary picture and all this nonsense. So, when you're looking at the banks, again, it's no surprise that they passed, but they're forced to keep a massive amount of being forced, right, to keep this capital on the balance sheet. So, after the stress test, they all come out. The large U.S. banks said that they're going to increase their payouts to shareholders, basically starting right now. Some banks started right now. Yeah, Goldman Sachs increasing their dividend by 25% from $2 to $2.50. Morgan Stanley increases its dividend by over 10%. Again, these are banks, and look where the markets are. And compare this to other recessions where banks are increasing their dividends. Bank of America increases dividend by a small amount. Wells increases dividend by 20%. Northern Trust, Truist, BNY Mellon all increase their dividend. It's a little surprised JP Morgan did not raise its dividend, but they've been raising it. Citigroup didn't either. They test results, every stress test are kind of on the lower end where they pass, but you could see the capital coming back in the market. And you think about that for a minute, right? Hey, wait a minute. We're on the brink of recession. Markets are down incredibly, 20% across the board, 30% for the Russell and NASDAQ. Yet the banks are perfectly fine. And what a positive data point. And again, we know the stress test, those requirements are a complete joke. Those conditions did not exist together since the Depression. But yet, those are the rules. Those are the laws. And for me, I'd rather banks lend the money out. I had trouble getting loans on my construction loan. I had trouble getting on a second house. I had to pay for cash for my mom. I mean, it was, and you look at the balance sheet, you look at the income coming in, you go to, own a business, stuff like that. And they still made it really difficult, really, really difficult to lend this money out. But anyway, expect more buyback announcements. And I was early to this a few months ago, so I'll take my lumps saying, listen, you should own a bank. We've owned Goldman Sachs, and Goldman Sachs has went up a lot, and then it came down. I said, it's a good buy. But when you see deleveraging, massive deleveraging at the same time, it doesn't matter what stock you own, right? It didn't matter what stocks in your portfolio, how good the earnings were, nothing. Doesn't matter. Doesn't matter if margins are high. If you look at the banks, they're pretty solid. Yeah, they're getting hit because you're seeing a slowdown, but banks' balance sheets are healthier than ever. And that recessionary conditions may reduce demand for loans, just seen a little bit, but banks are going to make a fortune in this rising interest rate environment. Absolute fortune. This isn't guesswork. Look at the numbers. I covered this a while ago. I mean, banks are licking their chops right now. Most of their profits came from fees and BS fees since the credit crisis. I'm not talking about investment banking fees, which are great, which you're going to see a slowdown there, but you're looking at the Fed. They pushed short-term rates to zero and kept them there for the majority of the past 12 years. So banks had to find ways to generate capital. That's why you're getting fees all over the place. And money in the bank, you get charging you left and right, wire fees, everything. It doesn't matter how much money you have in the bank, wire fees, everything. They just charge the fees. It's not fees anymore. I mean, that spread, that difference, that net interest margin is going to increase dramatically. So you see profits and margins take off for these companies. And you're going to see that in the coming quarters and going on well into the future as long as the Fed continues to raise rates and rates are this high. But why is that? Why the buybacks? Why dividend increase? It's the only thing they can do with their cash. And current laws are restricting the banks from growing. Granted, you could say they deserve it because they got stupid pre-credit crisis with mortgage-backed securities, hiding it from the authorities and creating synthetic of synthetic. They had a good idea, and then they just turned it upside down on its head and went nuts. So you could say they deserve it. Again, these laws are in place to make sure the banks are not too big to fail. And they're 3x to 5x larger than they were during a credit crisis, which means they're really, really too big to fail in this environment. But banks are really good investments in a rising interest rate environment. It's a deleveraging process, just like you're seeing in crypto. Every name in crypto got nailed, even though there's a huge separation between the top 50, 75 cryptocurrencies and the other 5,000, a massive difference. But a lot of them all got nailed. That's what happens when you see deleveraging, because people are forced to pay their debt off and get margin calls. And in order to do that, they have to sell the good stuff to pay off the bad shit. And that's what happens. That's why you're seeing your favorite stocks down. But let's look at some of the other data that we've been seeing over the past couple weeks. And you're going to notice it's a sharp change to what we're used to seeing, which is inflation surging across the board. Our goal 100% right now is to control inflation. Sound like a broken record? Talk about that for 18 months. Inflation's going to surge. It's going to surge. It's going to surge. You're handing checks directly to people. Fed says it's transitory. We make jokes about it. We had headlines of jokes. And look where it is right now. We all get it. Everybody knows it. All right? We're not talking about the past, not patting myself on the back, because I did have some losers in this environment. I didn't expect the market to absolutely crash the way it did. And some names are down tremendously. However, we need to stop inflation. We need to curb it. That is 100% the goal. And you know what? We're starting to see it. And no one's really talking about it. Everyone's talking about it's going to get worse. It's going to get worse. It's going to get worse. I mean, shipping data, so exports out of China is down. We're seeing a major slowdown in demand for furniture, appliances, and home decorating. Again, all related to housing. I don't know if you've been following commodity prices. Lumber, copper, have you seen them? Copper broke below $4. It's down 20% of the past month. Lumber prices were $1,300 in March. They're below $600. Down 55% in 3 months. These are deflationary signals. This is good. It means the Fed is doing the right job. They're starting to accomplish it. You're seeing it, and it's going to happen.